EPS came in at $1.39, totally beating consensus. Total core revenues hit $190.3 million. And their net interest margin, it stands at a really robust 5.45%. The stock definitely caught a bid after those numbers dropped.
Yeah, and honestly, for a regional bank sitting on an island that's constantly, battling hurricane recovery and undergoing this massive economic restructuring, those aren't just solid earnings beats.
Right.
I mean, those are the numbers of a legitimate fortress balance sheet.
Exactly. So today we are unpacking the mechanics behind OFG Bancorp's second quarter 2026 earnings report for you, the retail investor. Our mission here is to look way past those flashy top-line beats to trace the actual segment performance. We're going to dissect a very specific kind of glaring contradiction in their credit quality metrics and ultimately weigh the underlying risks in the Puerto Rican macroeconomic environment.
Because, look, in the banking sector, the headline numbers only tell you the what. The balance sheet and the management commentary, that tells you the how. And more importantly, it tells you whether or not those top-line numbers are actually sustainable over the next 4 quarters.
Yeah, we have to start with this top-line growth and the margin expansion because tracing where that bottom-line growth originated, it reveals some very specific non-recurring drivers. So we have that headline, earnings per share of $1.39.
Right.
That is a really significant sequential jump from $1.26 last quarter and a 20.9% leap from the $1.15 we saw a year ago in Q2 2025.
It's massive.
It is. And when we look at the core revenues, total interest income rose sequentially to $197.2 million. But, and this is why you have to dig into the report, $4.1 million of this income came from 3 fully paid commercial loans. That's up from, I think, $3.3 million from just one such loan back in Q1.
Yeah, and it's a crucial detail to pull out. I mean, the broader increase in interest income was absolutely driven by higher average balances of loans at, higher average rates. But those early commercial loan payoffs, they provide this sudden, concentrated burst of revenue. You just can't model that as a recurring event.
I always think of it kind of like a landlord. You have a tenant who suddenly decides to just pay a full year's rent in advance, plus a premium to break a lease early or something.
Exactly. Or think of like a cell phone contract. If a customer decides to cancel their contract 2 years early, they have to pay that massive termination fee.
Right.
So for the cell phone carrier, they suddenly get to recognize all that future expected profit and unamortized fees on day one. OFG essentially had 3 massive commercial clients pay off their loans early, meaning all those unamortized fees and early payoff premiums, they hit the income statement instantly in Q2.
Which is a fantastic cash infusion for the quarter, obviously.
Oh, absolutely.
Okay.
But you can't build a long-term growth thesis on the assumption that your biggest borrowers are going to just constantly pay you back years ahead of schedule.
Yeah, that captures the accounting mechanism perfectly. When a commercial loan pays off early, any of those deferred fees that the bank was planning to slowly recognize over the 10-year life of that loan, they're immediately accelerated.
Right, which inflates the sequential growth slightly. But what really requires a deeper look here is how this top-line yield plays into their net interest margin, or NIM. I mean, they printed a NIM of 5.45%.
Which is wild.
It's staggering. In a macro environment where the yield curve has been incredibly volatile and funding costs are just crushing a lot of regional banks, maintaining a 5.45% margin is huge. And to understand the mechanics of that, we had to look at the divergence between their interest income and their interest expense.
Yeah, that divergence is easily the most fascinating part of this whole earnings report to me, because total interest expense actually decreased sequentially.
Which you rarely see right now.
Exactly. It dropped to $39.9 million, down from $40.3 million in Q1. So they are pulling in significantly more interest on their loan book, but paying out less interest overall to fund those loans.
Given that we are still in a, relatively high-rate environment, how is management actually pulling off a reduction in interest expense?
Well, it comes down to a very aggressive, very deliberate strategy of balance sheet management. Because if you look at their core deposits, the standard retail checking and savings accounts, the cost of those actually went up.
Okay.
Yeah, they had higher average balances in those core accounts, and they had to pay a slightly higher yield to keep those depositors happy. But they offset that increased cost entirely by reducing their reliance on significantly more expensive funding sources. Specifically, they drastically lowered their average balances of borrowings and broker deposits.
Wait, let's define the broker deposits mechanic for the listeners, because that's where the real margin savings actually happen. Yeah, so a broker deposit is essentially wholesale funding. When a bank needs liquidity quickly to fund new loans, they can go to a third-party broker who pools money from yield-chasing investors.
Right.
Because this money is highly rate-sensitive and institutional, it is incredibly expensive. I mean, it is mercenary capital.
Right.
It will leave the second another bank offers even 5 basis points more.
Yep, no loyalty there.
Zero loyalty. Retail checking accounts, on the other hand, are sticky. People rarely move their primary checking account, even if they aren't getting the absolute highest yield, just because it's a hassle.
Right, setting up direct deposit again is a nightmare.
Exactly. So by intentionally shedding those expensive mercenary broker deposits and replacing them with sticky retail cash, OFG lowered their total interest expense. They literally swapped out high-interest wholesale debt for cheaper retail deposits, which is what mechanically widened that net interest margin out of 5.45%.
That makes total sense. And before we move off the margins, there is this calendar quirk that a lot of standard models just miss entirely. The second quarter physically had one extra business day compared to the first quarter.
Oh, right. Yeah.
And at the scale OFG operates, a single day of accruing interest is highly material. That one extra day actually added approximately $1.6 million to their interest income and only cost them about $0.4 million in interest expense.
It just underscores why quarter-over-quarter banking analysis requires looking at the actual day count. I mean, that extra day is a structural tailwind for Q2 that obviously won't compound infinitely.
So we've established that loan yields, early payoffs, and shedding broker deposits are driving the net interest income. But a bank's future revenue is entirely dependent on its pipeline. If they're shedding wholesale funding, they absolutely need sticky retail deposits to fund new loans.
Right.
So let's look at the production numbers. Sequential loan production hit $755.0 million. That is a massive 24% sequential increase from Q1, and management noted it was really broad-based across Puerto Rico, commercial loans, residential mortgages, and consumer loans. And to fund it, their customer deposit base grew by $84.9 million sequentially, hitting $9.74 billion. But I have to push back hard on this loan production narrative.
Okay, where are you seeing the weakness?
Well, the sequential 24% jump sounds phenomenal in a vacuum, but if you look at the year-over-year comparison,
All right.
new loan production is actually down 3.7% from Q2 of 2025. If sequential production is supposedly booming, why are they trailing last year's numbers?
Right.
Management claims this is due to some anomaly in auto sales last year, but I look at a year-over-year drop in loan production, and my immediate instinct is to wonder, is there underlying weakness in commercial real estate or business expansion that they're just masking with this auto loan excuse?
Look, it's a very fair skepticism, and it requires parsing the specific macroeconomic timeline of Puerto Rico over the last 12 months to really get it. The year-over-year dip is heavily concentrated in the consumer and auto segments, not commercial real estate.
Okay, so what actually happened last year?
Management's commentary on this is super specific. Q2 of 2025 saw this completely unprecedented spike in auto sales across the island, and it was due to a very real looming threat of new import tariffs.
Oh, wow.
Yeah, so consumers and fleet buyers just rushed out to buy cars before prices potentially spiked 10 to 15%. It pulled forward a massive amount of demand into that one specific quarter.
I see. So it's a baseline effect. Last year was the anomaly, essentially a statistical ghost, not a reflection of some broader macroeconomic slowdown today.
Exactly. If you strip out that specific auto loan spike from Q2 2025, the underlying commercial and residential mortgage production is actually trending upward nicely. But your point about funding remains the critical issue. Because even if we discount the auto loan spike, they still have to service these new loans efficiently and fund them cheaply. They need retail deposits. Which brings us to how they are actually acquiring those retail customers without, opening dozens of expensive new brick-and-mortar branches.
And this is where OFG's digital at the core strategy really comes in. The customer acquisition metrics they released are pretty striking for a traditional regional bank. 28% of their Libre accounts are now opened completely digitally.
Yeah.
They reported a 4% increase in net customers across retail and commercial, and their 90-day digital active users are up 11%.
The broader context here is structural operating leverage. Because digital adoption isn't just about, offering a sleek app to keep younger customers happy.
Right, it's not just marketing.
No, it is a fundamental cost-saving mechanism. It costs exponentially less to service a digital customer than it does to service one who walks into a physical branch and interacts with a human teller. Every time a customer opens a Libre account on their phone, OFG is acquiring that sticky, low-cost deposit funding we talked about earlier, but without incurring the overhead of a branch network.
They also noted that they delivered over 1.1 million smart banking insights monthly with a 90% plus positive feedback rate, which sounds great, but what does a smart banking insight actually mean in practice?
Basically, it's the deployment of AI and data analytics on the front end. So instead of just showing a customer their raw balance, the app analyzes their spending velocity.
Okay.
It might send a push notification saying, based on your typical utility bills, your current balance might not cover next week's automated payments. Or it might suggest moving excess cash into a higher yield savings product within the OFG ecosystem.
So it creates an incredibly sticky relationship. A lot of legacy regional banks struggle with deposit flight because mega banks or fintechs just offer way better technology. By building a mainland fintech level tech stack inside a traditional Caribbean regional bank, OFG is actively helping depositors manage their money, which makes it, much harder for that depositor to justify ever leaving.
It absolutely builds a moat around their deposit base. But look, aggressive digital acquisition and broad-based loan growth are only half the equation here. You can always grow your loan book if you are willing to lower your underwriting standards.
Which brings us to the potential cracks in the foundation. We have to look under the hood at the credit quality metrics to ensure OFG isn't buying this 24% sequential loan growth with, well, toxic debt.
Right.
When you look at the balance sheet, there is a glaring contradiction in the credit metrics for Q2. Net charge-offs, or NCOs, spiked to $28.8 million. That is 1.40% of their average loans, which is a steep climb from the 1.05% we saw in Q1. So the bad debt they had to officially write off as a total loss went up significantly.
It did.
Yet the provision for credit losses, the money they deduct from their earnings and set aside in a vault to cover future bad loans, drastically dropped. It fell from $22.5 million all the way down to $13.0 million. How can management mathematically justify slashing their safety net provision by nearly half while their actual realized loan losses are actively spiking?
It looks crazy on paper. When you see charge-offs spike by over 30 basis points in a single quarter, the immediate instinct is to just assume the underwriting models are failing.
Exactly.
But to untangle this contradiction, you have to look at a third metric, the non-performing loans rate, or NPL. Because while the actual charge-offs went up, the NPL rate absolutely plummeted down to 0.81%, which represents $67.3 million. That is a massive drop from the 1.47% NPL rate we saw just one quarter ago.
Okay, we need to break down how those three specific metrics, charge-offs, provisions, and non-performing loans, mechanically interact on a bank's balance sheet for the listeners.
Sure. So a non-performing loan is a loan that is currently in trouble. The borrower has stopped paying, usually for 90 days or more, but the bank hasn't entirely given up hope yet. The loan is still sitting on the balance sheet, acting as the dead weight, and the bank is actively trying to restructure it or recover the collateral.
Right.
A charge-off, on the other hand, happens when the bank finally accepts reality, recognizes the loss, and officially removes the loan from the asset column. What happened in Q2 was a highly strategic balance sheet cleanup. Management specifically noted the sales of a previously reserved telecom loan and a U.S. commercial loan.
So they essentially just ripped the Band-Aid off.
Exactly.
Instead of letting these toxic loans sit in the non-performing bucket and slowly bleed resources, they sold the debt, probably to a distressed asset buyer at a really steep discount. They took the immediate accounting loss, which caused the net charge-offs to spike to that $28.8 million. But in doing so, they completely cleared that bad debt out of the non-performing loan bucket.
Precisely. And because they cleared out those two massive lingering commercial loans, the total pool of current troubled loans, the NPLs shrank dramatically down to that 0.81%. Now, if we connect that back to the provision for credit losses...
Right. Why did it drop?
The provision is a forward-looking mathematical model. It dictates how much capital the bank must set aside based on the risk currently sitting on the balance sheet today. Because they took the charge-offs and cleaned out the old bad debt, their current balance sheet is statistically much healthier today than it was in Q1.
Oh, I see.
Yeah, their models just dictate that a healthier balance sheet requires less reserved capital.
That perfectly explains the drop to $13.0 million. But wait, if loan production is up 24% sequentially, are they under-reserving for the sheer volume of new loans they are taking on?
No, and the breakdown of that $13.2 million provision answers that directly. $14.7 million of that provision was allocated strictly to cover the pure volume increase of new loans.
Okay, so the math covers the new growth.
Exactly. The only reason the total number dropped to $13.0 million is because they received a $1.9 million benefit from commercial loan recoveries. So money they previously wrote off but unexpectedly managed to collect. So they are fully reserving for the new growth. They just aren't burdened by the old toxic loans anymore. It's actually a sign of a really proactive management team clearing the decks, not ignoring new risks.
Okay, that distinction is everything. They finished paying the bill for past underwriting mistakes, freeing up capital to support all this new growth. Now, to finalize this earnings recap, we have to transition from revenues and risk to operational efficiency and the macro environment. Let's look at what it actually costs to run the bank. Total non-interest expense ticked up to $102.8 million.
Yeah, and that uptick requires some context. Part of that $102.8 million is standard operational growth, sure, but Q2 included $5.8 million in business-related operational charges. You have to contrast that with Q1, which actually benefited from a $3.6 million business-related volume incentive payment.
Oh, so they had a benefit last quarter and a charge this quarter.
Right, so when you do a strict quarter-over-quarter comparison, the Q2 expense line looks a bit artificially inflated because you are losing a $3.6 million benefit and simultaneously adding a $5.8 million charge.
Despite those operational charges, the capital metrics pretty clearly prove out management's claim of a fortress balance sheet. Let's look at the CET1 ratio and tangible book value. Their CET1 ratio sits at a very healthy 14.07%.
Which is incredibly strong.
Yeah, for context, CET1, or Common Equity Tier 1, is essentially the highest quality, most liquid capital a bank holds, mostly common stock and retained earnings. It is the ultimate buffer protecting depositors against financial stress. Regulators usually require around 4.5% to 7%, so sitting at 14.07% means OFG is just incredibly overcapitalized and secure.
And their tangible book value per share, which, strips out all intangible assets like goodwill and represents what the company would theoretically be worth per share if they halted operations and liquidated all hard assets today.
Right.
That climbs sequentially from $30.14 to $31.12. It's just consistent fundamental equity compounding.
Management also provided their anticipated effective tax rate, or ETR, locking it in at 22.64% for 2026. Knowing the exact tax burden gives analysts a really clear, predictable runway for modeling bottom-line retention. But, no regional bank exists in a vacuum. We have to tie this capital strength back to the macro outlook for Puerto Rico.
Absolutely.
A regional bank's balance sheet is only as strong as the local economy it serves. And management painted a picture of serious structural tailwinds on the island, citing healthy consumer liquidity, wage growth, and historically low unemployment.
The Puerto Rican economy is undergoing a massive structural transition right now. For the better part of the 2010s, the narrative was entirely dominated by bankruptcy and outmigration. Today, the narrative is dominated by the influx of structural capital. Management heavily emphasized the federal reconstruction funding that's finally hitting the ground from past natural disasters.
Yeah, we're talking about billions of dollars flowing into ongoing infrastructure projects, grid modernization, and new manufacturing and onshoring initiatives.
Exactly.
But how does that federal money practically filter into OFG's commercial loan pipeline?
Well, it filters down through the entire supply chain. When a massive federal grant is awarded to rebuild a highway or modernize a power grid, the primary contractors need to hire dozens of local subcontractors.
Right, who need capital.
Exactly. Those local subcontractors suddenly need heavy equipment, new vehicles, and payroll financing to handle the massive contracts they've just won. They go to OFG Bancorp for those commercial loans. And then the employees of those subcontractors are now earning higher wages. So they go to OFG for a residential mortgage or an auto loan. The thesis is that this isn't some temporary post-pandemic bump.
It's a multi-year, structurally funded economic expansion.
Precisely.
But OFG is still sailing in open waters, and management was clear about the risks keeping them awake at night. They remain highly attentive to evolving macroeconomic conditions, specifically calling out the unpredictability of the interest rate outlook. If the Fed pivots drastically and cuts rates faster than expected, the yield on OFG's floating rate commercial loans will drop immediately, while their deposit costs might take months to reprice downward.
Which would aggressively squeeze that beautiful 5.45% NI.
Exactly.
They also cited geopolitical developments. Puerto Rico is an island economy. It is geographically isolated and entirely reliant on maritime shipping for basic goods and energy.
Yep.
Any geopolitical event that disrupts global supply chains or spikes energy prices disproportionately impacts the Puerto Rican consumer's wallet, which directly impacts their ability to service their consumer loans.
Which leaves a final thought to ponder as you update your financial models. Consider the dichotomy of OFG Bancorp. On one hand, it operates in a geographically isolated, historically traditional banking market in the Caribbean. But on the other hand, its aggressive digital transformation, like serving 68,000 customers through extended hour live virtual tellers, is yielding operational efficiencies that seriously rival sleek mainland fintechs. If they can achieve a 54.04% efficiency ratio, meaning it only costs them 54 cents to generate every single dollar of revenue, and a nearly 18% ROATC.
Return on average tangible common equity.
Exactly, meaning the raw profit they generate on the actual hard capital shareholders have invested is nearing 18%. If they can produce those metrics here today, how much of a moat does that digital-first strategy create against any legacy competitor trying to steal their deposit base?
It's the defining question for the stock right now. Is their technology spend just the cost of keeping the lights on? Or have they successfully built an impenetrable wall around their market share?
Be sure to follow the show for your daily, no-nonsense earnings coverage.